Your market news now. Asian shares declined as optimism over China's rescue measures faded. The equity rally in the U.S. has been fueled by falling inflation and the possibility that the Fed will cut rates this year. With the U.S. stock market at a record, the question for many investors right now is how much firepower is left in the rally that began late last year. Well, in Europe, shares of LVMH were up around 7% in early trade following the French luxury giant's latest quarterly reports, lifting peers including Hermès and Pernod Ricard, which were all up more than 3%. To give us more perspective on the market dynamics, we are joined by Skulk Low, who is a wealth manager at PSG. Skulk, thank you so much for your time. I want to pick up from, LVMH's share price moves, because if you look at the gauge of European luxury stocks, they were up 3.2%. And I'm wondering if those movements are trickling down to the likes of Richmond, which is listed locally.
Good afternoon, Nastasia. What a jewel of a day. What a day on the, well, not just the JSE. It seems like, globally, after LVMH came out, share price currently 11% up in Europe. Clearly stating that, this is the Christmas shopping, look at the Christmas bags, were clearly still filled with the major brands. So definitely that had a great impact. We saw Richmond guided earlier, let's call it this month or a week or so ago, with a similar trend, basically mentioning that most of the world, with the exception of Europe, is looking good with luxury goods, and that had a major effect on LVMH. And we, from a South African point of view, we're loving it. Richmond today also up over 4.5%. So yeah, I think that's a big one, and definitely a big major contributor to the market's movement, because we've seen, market opened this morning, as I said, jewel of a day. Market opened up much lower this morning, and after that, let's call it results, and it trickled through the market. We are now currently trading at about 60 basis points in the green.
So we also had Lewis release a trading update earlier today. What did you make of what they put forward?
Nastasia, you know what? It's sort of sweet and sour. We had a few of these retailers, I'm going to say food retailers, through AVI. We had Woolies reporting. We had the Foschini Group and Clicks reporting. Few retailers and food retailers. So I saw a similar trend in Lewis's results or trading update. Around about, let's call it the 9% growth level, which is exceeding inflation, which is always a good sign. Market is not liking the results that much. We're seeing the share price currently retracting today 1%. And I think, when I look at this, and I really look at this critically, I think it's where they've seen that growth. Now, if we look at the group sales, or let's call it the group credit sales, and that's all the goods that was bought on credit, that has grown by 17.5%. While the cash sales declined by 14.4%. So that's a bit of a worry, Nastasia, I must say. Sort of showing us the times we're living in. It's the tough times when things are turning, tougher. Yeah, we do see the consumer turn from a cash buy, because they don't have it anymore, towards credit. So yeah, market didn't really like that. I'm a bit worried about the trend that I'm seeing there, and definitely hope that we could start seeing interest rates declining soon.
Speaking of interest rates, I want to take things stateside. What's the big focus here ahead of the Fed decision next week?
Oh, Nastasia, I think, when we've seen the GDP levels, of the US, it's definitely not cooling down. That's the one thing. So we saw a massive beat from the US GDP. I'm sort of skeptical about this, because people tend to say, well, where did the growth come from? And I still very much believe, when you look at the forecasted 2% growth for the GDP, came out well above that 3.3%. When you look at the personal consumption, or let's call it the consumer buying in the US. Now, remember, when you look at the consumer makes up about 70% of the total GDP basket. Now, when you look at that growth, that has grown by 2.8%. Yes, slowing somewhat in the final quarter, but still growing 2.8%, just showing you that the US consumer, they definitely firstly went into their savings, used that savings to buy. Now we can see on the credit card debt, over $1 trillion, worth of credit card debt in the US. That is a massive, massive amount. Big worry for me. I don't really think the US is growing as it should be. Second point, I would say what they were going to look for is definitely inflation. Inflation number, I would say, is key. We know that most of the economists, we're going to hear what the Fed's going to say a bit later. Are they going to turn a little bit more, hawkish after they've been extremely dovish in November, saying this is it, we're going to pivot, we're going to stop this interest rate hiking cycle, and we are looking towards starting to decline rates. We know they sort of backpedal. There's big trouble, I think, in terms of getting oil across the world. Red Sea is still very much a no-go area for any of these oil tankers. And when I look at the oil inventories in the US, we also see that they've been not necessarily flooding, but definitely pumping a lot of the oil inventories into the market to try and stabilize the oil. That is a big worry. We know OPEC Plus is not pumping as they should be doing, which could put some inflationary pressures further on the markets.
Skalk, unfortunately, we have run out of time, but perhaps in our next conversation, after we've had that Fed meeting, we'll talk about how one positions themselves, especially as we talk of hopes of interest rate cuts. Unfortunately, we have run out of time, but let's leave it there. That is Skalk Low, who is the wealth manager at PSG, giving us his perspective on the markets.